Hello everyone, my name is Christian Weiss, ER Manager at RENK Group AG. I would like to give you a brief overview of our recently published 9-month figures. Some comments on our management board team because of the current news flow. As many of you may noticed, Ms. Wiegand will be leaving the company at the end of January 2025, and our current Chief Operating Officer, Mr. Dr. Alexander Sagel, has been appointed as Ms. Wiegand's successor. So this is, I think, already known. So now we move on to our 9-month figures. So first of all, some words to our order backlog. Compared to the second quarter of 2024, we see a slight increase of 31 million euros in the total order book from 5.7 billion to 5.8 billion euros, thanks to a stronger order intake in VMS. In addition, the order pipeline remains very encouraging. Fixed order backlog increased compared to year-end 2023 due to strong order intake in the second quarter of this year. Backlog visibility is the highest in our VMS segment. Of the fixed backlog, 1.3 billion euro or more than 70% of group fixed backlog is attributable to the VMS segment. That said, backlog in M&I has grown as well and stands at more than 400 million euro, or roughly a quarter of group fixed backlog, up 2 percentage points compared to Q3 2023. This gives the segment healthy 2 years of visibility. We see a larger volume of profitable business opportunities for the coming years beyond the projects that we have included in our soft and total order backlog. We move on to the next slide. Group performance for the third quarter of 2024 with our focus on our top line. We had a good flow of base orders during the quarter. Similar to Q1, we have shown that we are able to reach a book-to-bill ratio not far away from 1.0, even without large orders in VMS. For Q4, we see a good order pipeline. Fixed order backlog has increased by 100 million euros compared to the end of last year. Revenue growth reached a good level thanks to a strong growth at our VMS plants in Augsburg and Muskegon. Now we take a look at our profitability and other key metrics. Our Q3 adjusted EBIT came in moderately above the prior year level. During the third quarter of last year, after the first 9 months, our adjusted EBIT stands at 112 million euro. We anticipate a higher earnings run rate in Q4 2024 and reiterate our full year guidance of 175 to 190 million euros. Now we take a look to our segments. First of all, to our most important segment, the VMS segment. Revenue growth in VMS continues to be a key highlight for us. From an already strong growth level in H1 2024, growth accelerated further. Both of our key plants, which we produce transmissions for military vehicles, Augsburg and Muskegon in the US, contributed very nicely to revenue growth. Like in previous quarters, our aftermarket business grew at a higher rate than the new equipment business. The installed base is growing and we are enjoying growing aftermarket business on the back of this. When you assess the adjusted EBIT development in this segment, we already said on the Q2 call that the EBIT improvement should shine through with a time lag in Muskegon, and we are confident in further margin improvement in VMS in the coming quarters. To be clear, the numbers for RENK and Augsburg were very good in the third quarter, but there is work to be done in the US, but we are very confident that we can make it there too. Now we take a closer look to our M&I segment. For the M&I segment, order intake and revenues remained at a high level, consistent with our target to generate considerable growth in the full year. In Q3, specifically, order intake and revenues decreased compared to the previous year's level due to the high comparable base in that quarter. In the Q3, adjusted EBIT margin is at a very good level, close to 10% and only marginally below the first half margin, despite Q3 being a seasonally weaker quarter. For the full year, we still aim for a double-digit margin in that segment. That means improvement compared to the year 2023. We continue to take disciplined approach on the margin quality of our civil business. And this pricing discipline is paying off as well in terms of higher margins and higher backlog quality. And now we take a closer look to our last segment. It's the slide bearings segment, continues to experience strong profitability with solid revenue growth. Revenue growth reached a double-digit level again and exceeds typical growth rates in the capital goods sector. The segment management team has achieved capital efficient right areas. Electrification is a key trend driving demand for e-bearing, for example, in generators. Beyond this, demand for maritime bearings increased too, and aftermarket clearly outgrew new equipment business in this segment as well. Margin also remained at a very pleasing level during the third quarter and even improved slightly compared to an already strong Q3 2023. Now we move on to our net working capital ratio. And have a detailed look at it, and especially on the development of the net working capital. In Q3, net working capital as a percentage of revenues increased by nearly 2 percentage points. This was mainly driven by higher inventories and receivables, reflecting business growth. For year end, it's important to mention it is still fair to model 25% net working capital. In particular, we should receive advance payments, and we are also working hard on it reducing inventory levels structurally. In the midterm, net working capital should decrease to a level of around about 20%, and it is clearly one of our key priorities to reduce net working capital and improve the capital efficiency. On the next slide, we come to our cash flow statement. Overall, many aspects of our cash conversion were good during the third quarter. Underlying CapEx was low and cash outflows for interest, taxes, and other items close to normal levels. The increased net working capital has been a drag, but overall, we were still able to generate a slightly positive cash flow in Q3. This is despite the fact that we have digested a cash outflow for a payment to our technology partner Kinetic in Q3, which is included in our CapEx number. For Q4, we expect a reduction of the net working capital ratio to around 25%. For example, thanks to some prepayments that we anticipate to receive. Now we come to our last slide, to our guidance slide. We expect around 1.1 billion euros in terms of revenue for this year. growth in the first 9 months of this year was higher than the midpoint of the initial financial year guidance we have suggested. Growth prospects remain good across all of our 3 segments. And also keep in mind that we generate higher revenues as our ability to execute is much better than the last year, as supply challenges have been overcome and operational improvement has been achieved. We also reiterate our full year EBIT guidance for 175 to 119 million euros adjusted EBIT. And regarding our midterm targets, we see midterm targets of CAGR of 15% and a midterm target of 300 million euros in terms of adjusted EBIT. Now we come to our final slide, where we summarize our priorities and key challenges for the last quarter of this year. First of all, our first priority was the output increase at our main plant in Augsburg during the 3rd quarter, as well as the month of October. We were very pleased with the progress there. The monthly run rate of production has been above 60 in September, as well as October. And the adjusted EBIT contribution of the transmission unit in Augsburg was notably higher than in Q3 2023. We have increased the performance level in Augsburg and anticipate further growth from there. Our second priority is RENK America, or RAM, we call it. Naturally, we see the effects of our program there with a certain time lag compared to Augsburg, and the challenges in Muskegon are similar to those we faced in Augsburg last year. Now we have a very, very strong team in place and are spending more time in the US. And we are very confident that we can replicate the success we had in Augsburg in Muskegon. The improvement so far is already visible in certain performance metrics, especially output and revenues. We have added as a third point in this list growth as one of our key priorities. This includes extending our technology leadership, for example, by investing in hybridization or adding intellectual property in the area of advanced mobility technology. Our fourth priority is net working capital optimization. After a very successful first quarter in this respect, net working capital has risen again to a level that we consider to be too high. But we are very confident that a disciplined approach to inventory and prepayments we expect to receive in Q4 will bring the year-end ratio back down to a level of 25%. And last but not least, order intake. We are very pleased with the performance in the first 9 months and believe in a strong fourth quarter. The defense super cycle is still ongoing and in a full swing, and it's, of course, longer lasting. This is clearly visible in our order intake and order pipeline. And our CMD in September this year, we gave you more color on our order pipeline and identified a potential order book of 12 billion euros. This was our short overview of our 9-month figures. I hope you enjoyed the short presentation, and if you have any questions, please drop an email to our IR department. Many thanks for your attention.
Disclaimer. As described in the legal section on our website, seat11a.com, this publication is for informational purposes only. This means it is not intended to provide you with any investment advice. Any opinion or recommendation expressed by the companies is neither given nor supported by us and should not be considered investment advice from our side. Also, remember that any opinion or recommendation expressed is subject to change without further notice. The content is obtained from sources believed to be reliable, but we do not guarantee its accuracy, completeness, or timeliness. Seat11a.com and its employees disclaim all liability for any loss that may arise in any form from any use of the information in the video, audio, and on our website. We neither express any opinion on the future value of any security or other investment vehicle, nor recommend any investment based on the information provided. Please consider the publications and our website as a platform for companies to present themselves. You need to seek financial advice from an expert regarding the accuracy and appropriateness of the material presented or recommended by the companies in the publication. As we are just considered a publisher, we may hold and trade securities in the presenting company, whether it is a listed or private company. By consuming our content, you agree to these terms and the terms in our legal section on our website.